Hello. In the last class, we discussed about the material cost variances. Today, we will discuss about the labor variances, right? So, in labor cost variances, we will start with the objective. So, the objective of this session is to define labor cost variance and its components, explain how standards for direct labor are set, understand the calculation of direct labor variances, and analyze the key sub-variances like labor rate, efficiency, mix, idle time, and yield variances. So, let's start with the introduction. What is the definition of labor variance? It measures the difference between actual and standard labor cost. So, if we recall that we already discussed that the variance study we do to understand the difference between the standard cost and the actual cost, and whether it is a performance management tool, right? So its importance is critical for cost control in manufacturing processes. So as we know that labor is a very important cost component in a manufacturing process, and the management must be aware that what is the time the labor what is the cost the labor incurred, right, for manufacturing, and whether it is up to the standard or beyond the standard or it is below the standard. So, as we did earlier also, there can be favorable as well as adverse variances. So, we say the variance is favorable, right, when the actual cost is lower than the standard expected cost, right. So, this we say it is a favorable variance, right. This indicates a better than expected performance, right. Example, if workers complete a task in less time or at a lower rate than expected, and it leads to favorable variance. And also if it is not, if the actual cost is more, right, then we say it is an adverse variance, right. So, adverse variance is what? Where the actual costs are higher than the standard costs, and it is worse than expected performance, right. Example, if workers take more time or paid more than the standard rate. So, if the workers take more time or paid more than the standard rate, this leads to an adverse variance. So, impact is what? That impact is increased costs and lower efficiency. So, direct labor cost variance, how to calculate direct labor cost variance? This is the overall difference between the standard labor cost expected and actual labor cost incurred, right. So, this is the difference between standard labor cost expected and actual labor cost incurred. So, I can calculate it like this: standard hours into standard rate minus actual hours into actual rate. So, this is my total direct labor cost variance, right. Okay. So, if the actual hours and the actual rates are equal to standard hours and standard rates, then the variance will be 0. Fine. Okay. So, here is an example. Suppose, so standard wage rate is given as 5 per hour, standard time 1000 hours, actual wage rate 6 per hour, actual time 980 hours. Calculate the direct labor cost variance. So, we need to calculate the direct labor cost variance. So, we know the formula is standard hour into standard rate minus actual hour into actual rate. So, standard hours is 1000, right, and standard rate it is given here, it is 5, and actual hours 980 it is given here, and actual rate wage rate is 6, right. So, 1000 into 5 is 5000, and 980 into 6 is 5880, right. So, you see here the actual cost is more than the standard cost. So, it is adverse, right. Adverse, the difference between the two is 880, right. So it is an adverse variance. That means actual cost is bigger than the standard cost. The interpretation is the adverse variance indicates that the actual labor costs are higher than standard, possibly due to higher wage rates or inefficiencies, right? Here we can see from here that actual hours are less, right? Actual hours are actually less than the standard hours. So it took lesser time for completing the task, but the wage rate is higher, right? The actual rate is higher than the, so here it is 6 and here it is 5. So that is why the overall, the total variance is becoming adverse in this case. Labor rate variance. Now this total labor cost variance can happen because of two reasons, right? One is the rate is different or the hours are different, right? So labor rate variance is the difference between expected or standard and actual rates, right? So it is standard rate minus actual rate into actual hours. So standard rate minus actual rate into actual hours. Fine. Okay. So standard rate you see here again, right? The standard rate is given at 5 per hour, right? This is standard rate. Actual rate is 6 per hour. Actual hours it is 980. So standard rate, I can see here standard rate it is 5. So formula is standard rate minus actual rate into actual hours. Standard rate is 5, actual rate is 6 and actual hours is 980, right? So you can see here 5 minus 6 is minus 1. So minus 1 into 980. So 980 and it is adverse, right? The reason is simple. The reason is that the actual rate is more than the standard rate. So the rate variance, labor rate variance is adverse in this case. The adverse variance indicates the workers are paid more per hour than the standard rate, right? So it is an indication that the labor rate is higher. Labor efficiency variance. So another reason why the total labor variance, cost variance can be different from is adverse or favorable is the difference in efficiency, right? So efficiency means suppose that the number of hours actually taken, right, vis-a-vis the standard hours allocated. This variance shows the difference between the expected hours of labor and the actual hours worked, indicating how efficient the labor was, right? So it is the difference between the expected hours of labor and actual hours worked. Fine. So what is the formula? Formula is standard hours for actual production, right, minus actual hours into standard rate. Standard hours for actual production minus actual hours into standard rate. So this is my labor efficiency variance. Here is the problem. We can solve this problem like this. 1000 hours, the standard time for production. Actual time taken is 980 hours. Standard wage rate 5 per hour. Calculate the labor efficiency variance. What is the formula? The formula is standard hours minus actual hours into standard rate. So standard hours, you see it is given here 1000, right? Here it is given 1000, and actual hours given here, you see 980, it is given here 980 into standard rate is given 5, right? So labor efficiency variance will be equal to 20 into 5, so 100. It is here you see the actual time taken is less than the standard time. So it is favorable, it is 100 favorable, right? What is the interpretation? This favorable variance indicates that the workers were more efficient. They are doing the same work at less number of hours, completing the work in less than expected, less time than expected. So in this problem, the workers are to complete the job, workers were allocated 1000 hours, but actually they have taken 980 hours. So it is favorable for them, right? It is favorable. They are doing the same job at lesser number of hours. Now, labor idle time variance. This variance occurs when workers are paid for time when no production is happening due to machine breakdown or other disruptions. So, idle time variance is equal to idle hours into standard rate. So, idle hours into standard rate. So, here is the problem and its solution. Idle time 20 hours, standard wage rate rupees 5 per hour. Calculate the labor idle time variance, right? So, what is the formula? Labor idle time variance is equal to idle hours into standard rate. So, labor idle time variance is equal to 20 into 5, that is rupees 100, and here see it is adverse, right? This adverse variance shows that the company lost rupees 100 due to unproductive time. The next variance is labor mix variance. Labor mix variance measures the difference in cost due to a change in the composition of the workforce, that is using more or fewer skilled workers than planned. So, what is the formula? So, labor mix variance is equal to revised standard hours minus actual hours worked into standard rate. So, revised standard hours minus actual hours worked into standard rate. So, we can calculate it like this. Here is the problem. There are two grades of workers here. First one is grade A. Grade A, they have 80 at the rate of rupees 5 per hour. Actual they have taken is 100, right? Standard workers 120 at the rate rupees 3 per hour, right? Grade B, for grade B standard workers, actual they have taken is 80. Calculate the labor mix variance. Fine. So, we need to calculate the labor mix variance from this problem. You see, there are two categories of workers are working here, right? Grade A and grade B. So, first, their rates are different, their number of hours are also different. So, we need to calculate the revised standard hour for grade A first, right? So, it is 80 divided by total number of hours is 80 plus 120, that is 200, right, into 100 plus 80, right, the actuals, right, this 100 and this 80. So, if we solve, then it is coming to 72, right. For grade B workers, the revised standard hours are 120. 120 is coming from here, 200 is sum of 80 and 120, right, into 100 plus 80, it is coming from here, right. So, if we solve, then revised standard hour is coming 108, right. What is the formula? Formula is labor mix variance is equal to revised standard hours minus actual hours worked into standard rate, right. Revised standard hours minus actual hours into standard rate. Now, revised standard hours for grade A, we calculated here 72. So, I am bringing here 72. Minus actual hours, how much they worked? They worked 100. It is coming from here, right? Into standard rate. What is the standard rate? It is 5. It is coming here. So, it is 140, right? But here you see the standard hour is 72. And the actual hour is 100. That means actual hours are more than the standard hours. So, it is adverse. Fine. Similarly, for grade B workers, grade B, we can do it like this. Once revised standard hours is 108 minus 80, right? 80 is actual, right? Into 80 is coming from here, right? Into 3 per hour, so it is 3, so it is coming to 84, favorable, right. What is the interpretation? The overall variance indicates the labor mix was inefficient as more high-wage workers were used than planned. So, overall you see for grade B it is favorable, for grade A it is unfavorable, out of which what the grade A workers are high cost, right? They charge 5 rupees per hour where in comparison to rupees 3 per hour for grade B workers, right? So, the labor mix is it seems that it is inefficient in this case, right? And inefficient means it may increase the cost of production. Okay, fine. The next one is labor yield variance. The labor yield variance shows how much actual output varies from the standard outputs based on the labor time spent, right? So, labor yield variance is equal to actual yield minus standard yield into standard output cost per unit, right? Actual yield minus standard yield into standard output cost per unit. So, here is the problem and its solution. Standard time is 600 hours, standard rate 10 per hour, standard output 300 units, actual output 225 units. Calculate the labor yield variance, right? So, formula labor yield variance is equal to actual yield minus standard yield into standard output cost per unit, right? Standard output cost per unit is equal to standard hours into standard rate divided by standard output. So, what are the standard hours? Standard hours is here, you see it is given 600. So, it is coming to 600 hours. And what is standard rate? It is given here 10, right? So, it is 10 here, standard rate. Divided by standard output. What is my standard output? It is 300 units. So, it is coming to 300 units. So, if I solve it, we will get rupees 20 per unit, right? Now, calculation. So, labor yield variance is equal to actual yield. So, actual yield is here 225 actual output, right, minus the standard output, right, into the standard output cost per unit, that is 20, it is coming to 20 here, right. So, if we solve it, it is coming to 1500 and it is adverse. That it is adverse. Why it is adverse? It is adverse because your in this case, right, the actual output is 225, but the standard output should be 300. So, actual output is less than standard output, so it is adverse. Fine. Okay. This adverse variance indicates that the actual output was less than standard output, leading to higher costs per unit, right. This adverse variance indicates that the actual output was less than the standard output, leading to higher costs per unit. Okay. So, this is a summary. Labor cost variance helps assess the effectiveness of labor cost management. The main variances, rate, efficiency, idle time, mix, yield provide insights into different aspects of labor cost control. Thank you.